So let's be honest, most traders are stuck sitting on their hands watching perfect A+ setups play out right in front of them, and they just don't pull the trigger. They hesitate, they second guess, and by the time they think of entering that trade, the move is already gone. Now trust me, I've been there. I know exactly what it feels like to see your model present itself and you end up still not taking that trade. You're frozen, you're doubting yourself, and you're left sitting there thinking, why on earth did I not take that trade? But this morning, we did the complete opposite. We caught an absolute banger of a short trade inside the second AM macro, and that trade actually ended up running for over 80 handles in profit on NASDAQ. What model did we use, you may ask? The ICT unicorn model. High conviction, clean structure, and flawless execution. So inside of this video today, I'm gonna be breaking that exact trade down from start to finish. I'm gonna walk you through the model checklist, my real-time thought process, and how you can actually start executing on these same types of A+ setups instead of just watching them fly by. All right, so let's jump straight into it. All right, guys, so here you have the trade that we took. As you can see, it's an absolute beauty. Okay, take a look. But yeah, anyways, let's talk through my thought process going into the morning, what I was expecting, and gonna go over my buys. So I usually like to start on the daily time frame before I even do anything, just to figure out where is the market going to head to next. So if we go on a daily time frame, right, today did not seem that clear to me. Okay, we're at all-time highs. We're not really inside of any imbalances or fair value gaps. Hence, the bias is going to be tricky to pick, okay? Usually the way I pick my bias is if we're inside of a daily bullish fair value gap, for example, or a bearish daily fair value gap, okay? Then you can actually have a better idea of where price is going to head to next, okay? Or if you have a very strong drawn liquidity, for example, equal lows or equal highs on the daily time frame, then you can predict and expect where price is going to head to next. But today, I'll be very honest, it did not seem that clear to me. Hence, I was neutral, all right? Finally, you've landed in the right place. You've probably seen all of the payouts, the profits, the shilling results like this, and this. Over the last few years, I've gone from working inside of a warehouse to becoming a full-time, multi-millionaire day trader at just the age of 20 years old. And I've built everything from the ground up using ICT concepts. No fluff, no recycled content, just real results. But let me be completely honest with you. I should not even be here today. Exactly 1 year ago, I had a critical motorbike crash in Thailand that nearly ended up costing me my leg and nearly actually ended up costing me my life. Now, I'm not sure about you, but me personally, if I had lost a leg that day, I'm not too confident that I would be sat here today filming this video. Looking down and seeing raw flesh and white bones sticking out of your own leg, thinking, is this really it? Is this actually how it ends? That moment there made me realize your life can change in a split second, just from one bad decision. And so from that day onwards, it was all or nothing for me. I was going all into trading and I made it my mission to help others do the same. So I shut down my live trading group and I've built something 10 times better. This mentorship gives you literally everything that you need in order to become profitable trading ICT concepts all in one place. From trade breakdowns, risk management, psychology, and also live calls where I can actually keep you accountable. There's obviously way more inside, but I'm going to leave that as a little surprise for you lot once you actually gain access. But just know this, if your goal is to get funded and you want to get to the stage where you're receiving consistent payouts every single month, this is the right place for you. So right now, I'm opening up a few spaces. I don't care if you're completely brand new to ICT or if you've been trading for years. If you're actually serious and you're ready to lock in, I will personally take you under my wing and help you reach that next level. So fill out the quick form below. It takes less than 30 seconds and we'll speak shortly to see if you're the right fit for this mentorship. Speak soon. Now, the first thing that I'm looking for when I have a neutral bias is going to be a sweep of liquidity. All right, so if I'm not really sure where the market is heading and I'm neutral bias, I at least want to see some sort of liquidity sweep. Okay, so if we sweep buy side liquidity, for example, because we are neutral, we're open to both directions. So if we sweep buy side, we can expect a move lower. So this is exactly what happened inside today's trade. So as you can see here, we've come up on the 15-minute time frame. The best time frame to use is the 15-minute for session liquidity and intraday day trading. So this 15-minute high here got swept, and also we actually had London highs up here. So session liquidity got swept and we had a buy side liquidity get swept also. So even better, all right? If we sweep session liquidity like London highs, Asia highs, remember guys, that's gonna be more significant compared to just sweeping any high or low. So that right there is very good, and that's gonna be number one on the checklist. Now, after sweeping liquidity, we need to make sure that we're inside of the correct time window. So are we inside of a macro, right? If I zoom in here, we can clearly see we are inside of that second 10:45 to 11:15 macro. So the first 2 AM macros go from 9:45, 10:15, and then this is the second one, right? You have the lunch macro as well, which I don't really trade that often, but these are the 2 main ones. Now, after seeing a sweep of liquidity, the next thing that you want to see is a displacement. Now, with the unicorn model, if you don't already know what it consists of a breaker block that is paired with a FEG. Now, that is why it's such a high probability model, because you don't only have one PD array, you actually have 2. So the more PD arrays in one area, the better. Now, the breaker block and the fair value gap paired together is literally one of the most and highest probable algorithmic setups out there, okay? When I usually see this model, when it does occur and it's actually a clean setup, meaning everything is aligning, it rarely fails. And usually you'll get very little to any drawdown. So as you can see here, right, price came up. Once you got your entry, right, you had about 1 tick of drawdown. Like, that's actually crazy. What other strategy and model do you get that with? I don't see it anywhere, guys. I don't see anyone talking about this on YouTube. No one else is showing you lot this. So anyway, you must be wondering, you know, Ben, what is a breaker block? I don't know what that is. Okay, no worries. I've got you covered. A breaker block is 2 highs that are formed next to a buy side liquidity level, or it will be 2 lows at a sell side level. So we're looking inside this price leg here. Okay, so only focus on this area. We have that swing high, which is then followed by a swing low, which is then followed by another higher high, taking out that previous high. So any traders who are trading support and resistance, and they're trying to short at resistance, right? They're going short in this price leg here. They are then getting stopped out before the real move occurs. Okay, so once you get that next higher high, the last phase of the break block, you'll get that lower low, displacing below that swing low. Okay, now once we displace below that swing low, the lowest down close candle inside of that price leg will become your breaker block. Pause the video. Which candle do you think is the breaker block inside this price leg? Okay, so hopefully you pause the video there. I'm going to mark it out now for you lot. It's going to be this candle here. Now, here comes the beauty, all right? The fair value gap. When it's paired with the breaker block, it works amazing. And as you can see here, if you zoom in very closely, you can see a very tiny FEG there. I know it's very small, guys. However, it's still valid. It's still completely valid. We've had a valid displacement, right? A candle closure below a swing low. So that's a significant market structure shift, high probability. We've had a break below, we've had a breaker block formed, and we've also had a fair value gap formed. So yes, it is better if the fair value gap is slightly larger, makes it a little bit easier. However, this is still a completely valid trade to take. Now, a lot of new people coming in, they might hesitate, they might think twice, they might doubt themselves. I myself personally did not think twice. I entered straight away as soon as I seen this, because this is a A+ criteria model right here. So anyway, your entry usually should be at the fair value gap. Now, the maximum amount of risk or handles that I like to actually risk when trading this model is 30 handles on NQ. So usually, whichever PD array allows you to have 30 handles or less risk, that will be your entry point. So let's say, for example, the breaker block, if you enter, you're risking 40 handles, right? In that case, you're not going to be using the breaker block, okay? If the fair value gap gives you, let's say, 20 handles of risk, you use the fair value gap. So you want to use the PD array, whichever one is closest, but also whichever one gives you the correct risk management and valid stop loss placement. So sometimes you'll see me entering off a breaker, and sometimes you'll see me entering off a fair value gap, because there might be a scenario where I'm risking way too much and I have to enter off the next PD array, if that makes sense. Hopefully it does. If it doesn't, drop a comment in the comment section down below and I'll try to help you out. But that's the best way that I can explain it. So anyways, you enter of your chosen PD array, whether it's the breaker block or the fair value gap. In this scenario here, I actually entered off the fair value gap because I was waiting for price to enter macro time. So as soon as macro started, we had that entry on the FEG. Stop loss goes above the swing high. That is the ideal stop loss placement. If you're risking too much, it will usually go above the displacement candles high or above the breaker block. Just make sure you're risking no more than 30 handles, right? But try give that trade a little bit of room to actually breathe. Obviously, don't set a 5 or 10 handle stop loss because you're most likely gonna get stopped out. Give it some room to breathe. So once you have that in check, all right, you had the sweep of liquidity, we've swept London highs, all right? We've had the displacement, we've had the market structure shift, we've had the break block paired with the FEG, amazing. That's a unicorn model right there, okay? The next thing that you wanna do is obviously enter a valid stop loss placement, and you wanna target the opposing liquidity. Now, this is where most traders go wrong. They don't know where to target. So a very good tool that I highly recommend all of you start using, okay? Start looking at price ranges and price legs. So this right here is a price range. So from that swing low to that swing high, that is your whole kind of price range, right? You can measure this on TradingView with the tool, the fib tool, and find 50% of that range. Now, if you're shorting instead of a premium, what are you gonna target? You're clearly gonna target a discount. The best thing that I like to do when I'm shorting in a premium and I'm targeting a discount is find a inefficiency or fair value gap that hasn't yet been rebalanced or tapped into, resting just below that 50% level, meaning in a discount. So as you can see here, we have a clear large fair value gap resting just below that 50% level, which price ended up tapping into, right? So I had my TP1 at around the 50% range near equilibrium, and my TP2 was just in a discount at this sell side level here, with obviously this gap resting just below. And then we had final TP at the external sell side level, which we didn't get, but we ended up getting stopped out once we closed around 90% of our position. I only had one contract left on this trade, and obviously I was trading my stocks very aggressively, which then ended up just getting stopped out, which is completely fine. But it's very important as well to always make sure to leave that runner, whether it's one micro or one contract, just to see if you get that external sell side level. And yeah, also another thing, guys, always make sure to mark out your 8:30 open and your midnight opening price. That is very important. A lot of people ask me as well, you know, Ben, why do you mark out these levels? What they even do? How they help you? I use these levels to identify and kind of indicate whether price is in a premium or is in a discount. So usually if you're going short, you want to be buying above the midnight opening price or the 8:30 open. If you're going long, you want to be buying below the midnight opening price and below 8:30 open. That is a fair price. That's how you can use it. And another way that I also use these levels is to see whether we're inside of a premium or a discount. So if we're above 8:30 open and midnight open, then we're in a very deep premium, meaning you should only be shorting. Now, of course, there's exceptions to the rule. In some cases, right, different scenarios, you might be still going long, right? But 9 times out of 10, in most examples, if we're above 8:30 and midnight open, we're in a very deep premium and you should only be looking for shorts, realistically. Same goes for if we're below midnight open and below 8:30 open, you should be only looking for longs, as we're in a very deep discount. Just quickly, guys, before we end the video here, all right, I want to show you a few examples of what a break block actually looks like so you get a better understanding, because it is quite important when you're trading unicorn model. It's a very big part. It's a major part, actually. You need to have a break block that is paired with that fair value gap, all right? If there's no breaker block, then there's no unicorn model, right? Same goes for if we just have a breaker and no fair value gap, or if you just have a fair value gap and no breaker, right? It has to be the two together paired, right? If one of us is missing, that's it. It's not a unicorn model. You're trading a completely different strategy. So anyways, imagine a buy side level here, right? Price will come up. Traders will start shorting resistance, right? It will then come down and then stop all of those traders out. So these traders that went short here, they're getting stopped out, and price is also tapping into that buy side level, taking out even more liquidity, right? Only then do we get that real move down, right? Once we get displacement, the lowest down close candle instead of this price leg here, right, becomes your breaker block. And now usually when price displaces below that low, it will leave a fair value gap behind it, which is then paired with that breaker. The same goes for the bullish example, right? Price comes down, traders are trying to long support, it will bounce back up, it will then stop them out, right? And tap into that sell side level, taking out even more liquidity, and only then does that real move occur, displacing above that swing high. Now in this scenario here, because it's a bullish example, it won't be the lowest down close candle, it will be the highest up close candle inside that price leg, all right? So bullish example, of course, it's gonna be a green candle. Bearish is gonna be a red candle, depending on your chart colors and how you've set it up. Those are the basics, and that's how it goes. And obviously then you would expect for price to retrace and either get an entry at that breaker or fair value gap. The best setups occur when the fair value gap and breaker is overlapping perfectly, meaning the fair value gap isn't higher, it's not lower, the breaker's not higher, the breaker's not lower. It will look something like this, right? Whereas you get some cases as well where the breaker will be higher than the gap, it will look like this, or the gap will be higher than the breaker and it will look like this, right? And then you have to decide which one do you enter from. So I hope that made sense, guys. I hope you found this video insightful, right? If you have, please leave a like, leave a comment, share, and subscribe. If you're actually serious about getting your trading to the next level and you want to finally become profitable trading ICT concepts, make sure to check out all of the links in the description below. Join the mentorship. We trade live every single day. You also get full access to the A to Z course, including everything that I've learned over the past 5 years of trading, various entry models, the 2 ICT models that I trade every single day are also broken down inside of there. Trade breakdowns and literally everything that I wish I had when I first started out is inside of there. All right, so I'm not gonna reveal too much. I'll leave that as a surprise for when you do actually gain access. But yeah, if you are serious and you're ready to lock in, all of the links are in the description below. But yeah, other than that, guys, hope you lot enjoyed, and I'll see you lot in the next one. Take it easy.